Welcome back, students, to Accounting 100, and today lesson 3 is based from chapter 5 in the textbook. Chapter 5 introduces inventory accounting for the manufacturing and merchandising business models. We will introduce and discuss 4 cost flow methods that are allowed under the generally accepted accounting practices. Although the firm has a choice of methods, once a choice has been made, the firm is not allowed to change to a different method without a substantial reason. The cost flow method chosen has a large effect on the gross margins reported in the income statement, and so we want to make sure we understand this thoroughly. To begin with, the 4 cost flow methods are specific identification, first in, first out, also called FIFO, last in, first out, LIFO, and the weighted average method. The actual physical flow of goods may not match the accounting method chosen. This is fine as long as you are consistently using one accounting method only in the books. Goods usually move physically in a FIFO basis, meaning that the oldest inventory is generally sold first. An example to the contrary would be a pile of gravel where the gravel on top of the pile is sold first, since it's the only material that is accessible. And that would be LIFO, last in, first out. Since inventories often consist of identical goods purchased at different prices, we need a system to calculate the cost of goods sold that calculates the gross margin generated by each sale. We find that the last merchandise inventory usually costs more than that purchased earlier. This is because we live in a generally inflationary type system where we are marked by rising prices. This is because the environment is inflationary. The opposite is a deflationary environment characterized by generally falling prices. Under the more common inflationary scene, FIFO will show a lower cost of goods sold than a LIFO system. This is because we're counting the older, cheaper products first and the newer, higher-priced products after the earlier units have been used up. This has the effect of increasing reported income, which in turn triggers higher current taxes. LIFO has the effect of reducing income and therefore taxes in the current accounting period. Note that the taxes are not actually reduced, just delayed. Later on, as we sell the older merchandise, we'll pay the higher taxes. Still, the temporary tax savings can be quite large, millions or even hundreds of millions of dollars, depending on the size of the company. And it works just like a free loan of funds that can be used for working capital until taxes become due, and the higher taxes come due at a later period. To really understand the differences, answer the Check Yourself problem 5.2 found on page 256 in the yellow and green highlighted box. This should clarify things a bit. We generally contrast the FIFO and LIFO methods since they show the greatest differences. The weighted average method will show a cost that is between the two. The specific units method is neutral since we are tracking a single item only. An example would be an auto dealer where each car comes with its own individual cost sheet. Note that using LIFO or weighted average methods can cause timing problems that are partially overcome by using a perpetual inventory system as opposed to a periodic system. This is an advanced discussion that's beyond the scope of the current textbook, but they mentioned it here anyway. Final inventories are reported at either historical cost or actual market value, whichever is the lower. Any losses due to damage, deterioration, obsolescence, theft, or price deflation is recognized during the current accounting period. Inventory accounting presents an opportunity for fraud. The accounting system includes a number of tools and controls that help reduce this possibility. The authors discuss some of these practices on page 251 and 252. A fuller treatment of fraud is presented in the auditing classes taught here at IAU. The check yourself problem 5.3 on page 263 shows how a difference between physical count and estimated count can be ignored, in this case because it is not material. Materiality is a principle we haven't discussed yet, but it means that if the amount of money is relatively small within the greater picture, you can ignore it. This is why the IRS allows us to round off our taxes to the nearest dollar, even if it means they lose a few pennies in revenue. I know that sounds unrealistic, but it's true. We close with a discussion of gross margins and inventory turnover rates on profits. This analysis can be very useful for measuring the relative stability and efficiency of different firms in the same industry. As we compare across industries, we discover that each is represented by a slightly different and sometimes a greatly different inventory turnover rate. The discussion questions, we're going to skip all but the last two problems in the discussion questions for Chapter 5. So do the last two discussion question problems and you will receive full credit for the entire chapter. All right, looking forward to seeing you in a couple of days, and be wearing something more than a t-shirt at that time. By the way, this is my Firefighters Union t-shirt. No, I was never a firefighter, but they did support me as I ran for public office. Well, another story for another day. Bye-bye.